The Cayman Islands, a speck of Caribbean paradise, is better known today for finance than for its beaches. It's a British overseas territory of just over 100 square miles and roughly 70,000 people, hardly the profile of an economic giant. Yet over the past several decades, the Caymans have transformed from a sleepy, resource-poor colony into one of the most powerful forces in global finance. Let's explore how a small island territory became a financial superpower, leveraging tax incentives, tight secrecy laws, and a canny legal framework that lured banks, corporations, hedge funds, and even shady operators from around the world. In the mid-20th century, the Cayman Islands had little to boast about economically. Isolated and lacking natural resources, the islands subsisted on fishing, shipbuilding, and a trickle of tourism. For generations, Caymanians made do without prosperity. The territory was often called the islands that time forgot. But the 1950s and 1960s brought a turning point. Modern transportation and communications began opening the Caymans to the wider world, and local leaders saw an opportunity in the one asset they had in abundance: the absence of taxes. Unlike most countries, the Cayman Islands had no income tax, no corporate tax, and no capital gains tax. In fact, no direct taxation at all. This quirk wasn't a recent invention, it had deep roots. Local legend holds that in 1794, after Caymanian boatmen heroically rescued British sailors from a shipwreck, the famed Wreck of the Ten Sails, the King of England promised never to tax the islands. Whether or not that story is true, the Cayman Islands remained tax-free into the modern era. By the 1960s, that status was a potential goldmine, a tax haven to attract foreign money. All that was needed was a legal and regulatory framework to welcome the world's wealth. At the dawn of self-governance, the Caymans had just split administratively from Jamaica in 1959. The tiny territory set about crafting laws to court international finance. The Companies Law of 1960 was a landmark. It provided a straightforward regime for incorporating businesses and signaled that the islands were open for offshore business. Crucially, when Jamaica became independent from Britain in 1962, the Cayman Islands chose to remain under British sovereignty. This decision would pay dividends. It gave investors confidence in the Caymans' political stability and English common law legal system. In a world of decolonization turbulence, Cayman remained a dependable outpost of the British Crown, meaning reliable courts, property rights, and rule of law, all in a low-tax package. During the 1960s, officials, with help from British and Canadian lawyers, enacted a flurry of financial-friendly laws. They modeled many statutes on those of another offshore center, the Bahamas, and on British legal principles. New regulations made it easy for foreign banks to set up shop. By 1966, the government passed the Banks and Trust Companies Law, laying down a framework for licensing banks and protecting deposits. Other acts modernized trust law and allowed the formation of exempted companies that would do no local business and thus remain tax-free. In essence, the Caymans built a playground for global finance: minimal taxes, minimal red tape, and familiar British-derived laws to ensure legitimacy. The timing was perfect. The late 1960s saw a boom in offshore banking. Major US and European banks were seeking havens to book deposits and loans outside stringent home country regulations. Nearby in the Caribbean, places like the Bahamas and Bermuda were already thriving as offshore centers. But political winds shifted. The Bahamas experienced instability and eventually independence in 1973, which made some financiers nervous. The Cayman Islands, by contrast, stayed a British territory with steady governance. As Nassau's star dimmed, Georgetown's began to rise. Banks that wanted a stable, Anglophone base in the Americas found it in the Caymans. By the early 1970s, dozens of international banks, from Chase Manhattan to Barclays, had opened branches or subsidiaries there. Another key ingredient in the Cayman success story was secrecy. In the 1970s, the jurisdiction solidified its reputation as a place where financial information stayed in the shadows. In 1976, lawmakers passed the Confidential Relationships Law, which imposed strict penalties for divulging confidential information about financial clients. In effect, it became a crime to spill secrets about offshore accounts and companies registered in the islands. This legal cloak of anonymity was a magnet for all kinds of money. Wealthy individuals and corporations valued privacy, and in some cases, secrecy meant safety for assets. Cayman's message to the world was clear. Funds parked here would be secure and largely hidden from prying eyes. By the late 1970s, the Cayman Islands had firmly joined the ranks of global offshore financial centers. Its population was still only a few tens of thousands, but the amount of money flowing through was staggering. Known then as a banking paradise, the territory became a refuge for deposits of eurodollars, petrodollars from oil-rich states, and wealth from Latin America's elites seeking stability away from turbulent home economies. The combination of zero taxes and stringent confidentiality created a booming industry of offshore banking, trusts, and shell companies. Local government and business leaders worked hand in hand to nurture this growth. A small cadre of Caymanian visionaries, figures like Sir Vassal Johnson, the island's first financial secretary, championed the financial services sector as the future of the economy. They established regulatory bodies and encouraged public-private collaboration to continually refine laws to attract more business. When a bank collapse or scandal struck, such as the 1974 failure of an early Cayman-licensed bank, an incident that prompted creation of a stronger banking inspectorate, the response was to tighten oversight just enough to reassure investors without scaring away the hot money. It was a delicate balance, but Cayman officials became adept at playing both promoter and regulator. As the 1980s and 1990s rolled in, the Cayman Islands financial sector exploded in size and scope. By the mid-1980s, scores of the world's largest banks and accounting firms had offices in Georgetown. Financial services overtook tourism as the main pillar of the economy. Caymanians enjoyed rising incomes and living standards funded by this influx of global capital. The government, notably, still refrained from income or corporate taxes, instead raising revenue through licensing fees, import duties, and other service charges on the booming finance industry. By 2007, financial services accounted for over 50% of GDP, one-third of all jobs, and nearly 40% of government revenues. Truly the lifeblood of the territory. One major growth area was investment funds. The Caymans realized that beyond banking, there was a lucrative niche as a home for hedge funds and mutual funds. The Mutual Funds Law of 1993 provided a regulatory framework that was light touch enough to entice fund managers while still offering a veneer of oversight. The result was astonishing. Within a decade or two, the Caymans became the world's leading domicile for hedge funds. By the 2000s, it was estimated that more than half of all hedge funds globally, by some counts, upwards of 75%, were legally registered in the Cayman Islands. These funds managed vast sums of money, yet often did little more on island than maintain a P.O. box and some legal paperwork. Still, the fee income and prestige for Cayman grew with each fund launch. Corporate registrations also skyrocketed. Multinational corporations, from Silicon Valley tech giants to Wall Street banks, discovered they could route profits through Cayman subsidiaries to minimize taxes back home. The Cayman Islands offered tax-neutral vehicles. A company could be incorporated there and pay no tax on its earnings, potentially deferring or reducing taxation elsewhere. By the mid-2010s, the number of active companies registered in the Caymans was hovering near 100,000, far outnumbering the island's population. To give a sense of scale, a single modest office building in Grand Cayman, the now infamous Ugland House, serves as the registered address for thousands upon thousands of companies. In 2009, U.S. President Barack Obama pointed to Ugland House's 18,000 listed corporations as a symbol of offshore tax evasion, joking that it was either the biggest building in the world or the biggest tax scam in the world. The image was striking. Behind the sun-soaked facade of a tiny tropical territory lay a dense paper empire of shell companies and investment funds, tying the Caymans to virtually every corner of the global economy. By the 2010s, the Cayman Islands were unquestionably a financial powerhouse on the international stage. The territory ranked among the top 5 global banking centers by assets. at one point boasting over $1.5 trillion in banking liabilities booked on its shores. It was home to branches or subsidiaries of 40 of the world's 50 largest banks. In sectors like insurance, Cayman became a leader as well, especially in captive insurance, where a company self-insures through its own Cayman-based insurer. All of this was achieved while maintaining the core allure: zero direct taxes, a pro-business legal environment, and a reputation for steadfast secrecy. The Cayman success, however, had a darker side. The same features that attracted legitimate businesses and investors also drew illicit actors. Over the years, a rogues gallery of tax evaders, money launderers, corrupt officials, and even drug traffickers have been linked to Cayman accounts or shell companies. In the 1980s, as the cocaine trade boomed, American authorities grew concerned that drug cartels were stashing profits in Cayman bank accounts far from U.S. law enforcement. In one notorious case, the rogue Bank of Credit and Commerce International, later unmasked as a hotbed of fraud and money laundering, used its Grand Cayman affiliate and secret Caymanian entities to hide billions in losses and illegal transactions. When BCCI's House of Cards collapsed in 1991, investigators found the Caymans had been one of the key havens enabling the scheme. Scandals like BCCI and Enron, the U.S. energy giant that hid liabilities through hundreds of offshore entities, many in Cayman, gradually eroded the notion that all was pristine in paradise. As trillions of dollars flowed through offshore centers, global regulators and governments took notice. Beginning in the 2000s, there was mounting pressure on tax havens like the Cayman Islands to clean up their act. International bodies such as the OEC and the Financial Action Task Force put the Cayman Islands on notice for weak transparency and potential abuse by criminals. In 2000, the FATF briefly blacklisted the Caymans for inadequate money laundering controls, prompting the local government to swiftly pass new anti-money laundering laws and regulations. The Cayman authorities gave regulators greater access to banking records and required financial institutions to vet clients. Measures almost unthinkable in the laissez-faire 1970s, but necessary to shed the blacklisting stigma. The United States, worried about tax losses and dirty money, also acted. The U.S. Treasury and Congress launched crackdowns on secrecy jurisdictions. Barack Obama's administration, for instance, tightened rules on American companies deferring taxes through offshore profits, specifically calling out places like Cayman. Later, the implementation of the Foreign Account Tax Compliance Act forced offshore banks to report Americans' accounts to the IRS, a major blow to secret bank accounts. European nations, too, pressed Cayman to sign information-sharing pacts and to ensure that companies aren't just empty letterboxes hiding profits. In 2020, the European Union even briefly blacklisted the Cayman Islands for not doing enough to prevent tax abuse, though Cayman was removed after it adjusted its laws on investment fund regulation. Perhaps the biggest public relations hits came from large data leaks. The Panama Papers and Paradise Papers, vast troves of leaked documents from offshore service firms, exposed how the world's rich and powerful routinely used havens like Cayman to shelter assets. These leaks, while focused on various jurisdictions, confirmed that the Cayman Islands were deeply embedded in the offshore networks of celebrities, politicians, and corporations. Names of famous figures and global companies appeared, tied to Cayman trusts or shell companies created to obscure ownership. While not all this activity was illegal, the opacity of Cayman's system made it hard to tell legitimate tax planning from outright evasion or money laundering. Stung by such scrutiny, Cayman officials have worked to polish the jurisdiction's image. They emphasize that the Cayman Islands today adheres to international standards and is tax neutral rather than a tax dodge. The government has signed dozens of tax information exchange agreements to share data with other countries' tax authorities on request. It has strengthened due diligence requirements for financial firms and created a register of company owners, though not fully public, to deter anonymous hiding of assets. These steps illustrate a balancing act. The Cayman Islands must convince the world it is a responsible financial center while still preserving the key advantages, low taxes and efficiency, that make it attractive. In just a few generations, the Cayman Islands have charted a remarkable course. Through savvy policy choices and an unapologetic courting of offshore wealth, this tiny territory built an outsized financial industry that touches every corner of the globe. Today, gleaming office buildings in Grand Cayman house branches of the biggest international banks, law firms, and accounting companies. Investment fund registrations continue to be robust, and new sectors like fintech and cryptocurrencies are even finding a toehold on the islands. Cayman's story is often held up as a model by other small jurisdictions eager to leverage niche advantages, though it also serves as a cautionary tale about the ethical and legal gray zones of global finance. For the Caymanian people, the finance sector has brought immense prosperity. The islands now enjoy one of the highest per capita incomes in the world, and a standard of living unheard of before. Glossy skyscrapers and luxury condos now rise where traditional villages once stood, as the wealth generated from global finance circulates into the local economy. Yet there remains an ever-present tension between the light and shadow of this success. The same laws and policies that attracted legitimate investment also opened doors to abuse, requiring constant vigilance and reform to keep the Cayman Islands on the right side of history. Thanks for watching this video. If you enjoyed it, don't forget to leave a like and subscribe to our channel so you don't miss any future videos.